Bitcoin ETFs and Ethereum ETFs may sit beside each other in a brokerage account, but they do not represent the same investment thesis. A Bitcoin ETF is primarily a bet on digital scarcity, monetary adoption, and continued demand for an asset with a fixed maximum supply. An Ethereum ETF is a bet on the growth of a programmable blockchain, used for stablecoins, tokenized assets, decentralized finance, and other applications. That difference matters when deciding which one deserves more of a portfolio. The correct answer is not automatically the asset with the strongest recent performance. It is also not necessarily a 50-50 split simply because both belong to the crypto market. The decision depends on what role each asset is expected to play. Bitcoin may serve as the simpler core position because its thesis depends mainly on scarcity, security, and adoption as a monetary asset. Ethereum may serve as a higher-risk satellite because its value depends on network activity, protocol development, competition, and token economics. Ethereum can also offer staking rewards through certain exchange-traded products, adding potential income but also additional complexity and risk. Throughout this video, we will compare ETF structure, liquidity, costs, staking, volatility, value creation, and portfolio role. We will also examine the strongest bull and bear case for each asset. The goal is not to predict which cryptocurrency will produce the highest return next year. The goal is to determine which thesis is easier to defend, which risks are being accepted, and how much exposure belongs inside an already diversified portfolio. Before comparing Bitcoin with Ethereum, however, we need to clarify what an ETF investor actually owns, because purchasing a crypto fund is not the same as holding BTC or ETH directly. When an investor buys a spot Bitcoin or Ethereum exchange-traded product, the investor generally owns shares of a trust or fund. The trust holds the underlying cryptocurrency through a custodian. This provides price exposure inside a traditional brokerage account without requiring the investor to create a wallet, protect private keys, or transfer assets across a blockchain. For many investors, that simplicity is the main advantage. The shares can often be purchased inside the same platform used for stocks, bonds, and retirement accounts. Tax reporting may also fit more naturally into an existing brokerage workflow. But convenience changes what the investor can do. An ETF shareholder normally cannot withdraw the underlying Bitcoin or Ether from the trust. The investor cannot move the assets to a personal wallet, use them in an on-chain application, or directly choose how they are staked. Trading is also generally limited to market hours, while native cryptocurrency trades continuously. Direct ownership provides more control. The investor can use self-custody, transfer the asset at any time, and participate directly in the network. But that control creates responsibility. A lost private key, compromised wallet, or incorrect transfer may result in permanent loss. An ETF introduces a different chain of risk. The investor depends on the brokerage, the fund sponsor, the trust structure, and the crypto custodian. Neither structure is automatically safer in every situation. They solve different problems. The ETF reduces operational complexity but also removes direct control. Direct ownership increases flexibility but requires technical competence and stronger security practices. For this comparison, we are focusing on exchange-traded exposure because that is the structure most traditional investors will use inside a portfolio. With the ownership structure clear, we can move to the first investment thesis: why someone would choose a Bitcoin ETF. The Bitcoin thesis begins with scarcity. Bitcoin's protocol limits the maximum supply to 21 million coins. New supply enters the market through mining, and the rate of issuance declines over time through scheduled halving events. This creates a relatively simple economic framework. If long-term supply is limited while demand increases, the price may rise. Demand can come from individual investors, financial advisors, institutions, corporations, or even governments. Spot ETFs make that demand easier to express through traditional financial accounts. An investor no longer needs to understand wallets, exchanges, or private keys to gain exposure to Bitcoin's price. That accessibility is one reason Bitcoin ETFs have attracted significantly more assets than Ethereum ETFs. The thesis is also relatively easy to explain. Bitcoin is not primarily valued because it produces income or generates corporate cash flow. It is valued because investors believe it can function as a scarce global monetary asset. Supporters compare it with digital gold, although the comparison is imperfect. Bitcoin is more volatile, has a shorter history, and depends on technology and network security. The simplicity of the thesis can be an advantage. There are fewer moving parts than in a smart contract platform, but simplicity should not be confused with low risk. Bitcoin does not produce earnings. There is no dividend, rental income, or interest payments supporting the valuation. The price depends heavily on what future investors are willing to pay. If adoption grows, the fixed supply can become powerful. If demand weakens, scarcity alone does not prevent a large decline. A Bitcoin ETF therefore represents a monetary adoption thesis rather than a conventional cash flow investment. Ethereum begins from a very different position. Its value is tied not only to ownership and scarcity, but also to the use of an entire programmable network. Ethereum is not designed only to hold and transfer a scarce digital asset. It is designed as a programmable settlement network. Developers can build applications, issue tokens, create financial contracts, and transfer digital assets through the Ethereum ecosystem. ETH is the native asset supporting that activity. Users generally need ETH to pay transaction fees. Validators stake ETH to help secure the network. Part of the transaction fee is burned, permanently removing that amount from circulation. This creates a more complex value accrual model than Bitcoin. If stablecoin activity grows, more transactions may use the network. If tokenized securities and real-world assets expand, Ethereum may process more settlement activity. If decentralized applications attract more users, demand for block space and ETH may increase. Staking can also remove some ETH from liquid circulation while providing rewards to validators. The bullish thesis is therefore based on network growth, application activity, and the economic role of ETH inside the system. But utility introduces more variables. Ethereum must continue attracting developers and users. It must remain competitive against alternative blockchains. Protocol upgrades must work as intended. Layer 2 networks must expand Ethereum's capacity without capturing too much of the economic value. Regulation must not prevent important applications or staking services from developing. This means Ethereum may offer greater economic utility, but it also creates more ways for the thesis to fail. Bitcoin asks whether a scarce digital monetary asset will gain broader adoption. Ethereum asks whether a programmable blockchain will continue becoming a major settlement and application platform, and whether that growth will create value for ETH holders. Now that the two investment theses are clear, we can examine how investors have actually allocated capital between their exchange-traded products in 2026. The 2026 ETF market shows a significant difference in scale between Bitcoin and Ethereum products. Using two representative spot products from the same sponsor, the Bitcoin fund held approximately $46.9 billion in net assets near the end of July. The comparable Ethereum fund held approximately $5.5 billion. That does not prove Bitcoin will outperform, but it shows that Bitcoin currently has the larger institutional investment vehicle. The liquidity data tells a similar story. The Bitcoin product traded with a median bid-ask spread of approximately 0.03%. The Ethereum product spread was closer to 0.07%. Both are relatively liquid, but the tighter Bitcoin spread can reduce trading friction, especially for larger or more frequent transactions. Trading volume also matters. Higher volume can make it easier for market makers to keep prices close to the value of the underlying cryptocurrency. But investors should not compare only the number of shares traded. One fund's share price may differ significantly from another's. Dollar volume, spread, and depth of the order book provide more useful context. The asset gap also reflects product history. Bitcoin spot products reached the United States market earlier and entered with a more established investment narrative. Ethereum products had to explain a more complex asset, and early products did not initially capture staking rewards. Market size can create a network effect of its own. Financial advisors may prefer products with deeper liquidity, longer trading histories, and larger asset bases. That can attract additional capital to the already larger vehicle. Still, size alone does not determine which asset deserves a larger portfolio allocation. It tells us that Bitcoin ETFs currently offer the more mature market structure. The next step is examining what investors actually pay for that structure, because the published expense ratio is only one part of the total cost. Investors often compare crypto funds by only looking at the sponsor fee. That fee matters because it reduces the fund's assets every year, but it is not the only cost. The bid-ask spread creates an immediate trading expense. A buyer generally pays slightly more than the midpoint price, while a seller receives slightly less. The wider the spread, the more performance is lost when entering and exiting the position. Tracking difference is another cost. A fund is designed to follow the price of its underlying cryptocurrency, but fees, operational expenses, cash balances, and trading mechanics may cause the return to differ slightly. Premiums and discounts can also appear. The market price of the shares may temporarily trade above or below the value of the crypto held by the trust. The creation and redemption process helps keep those values close, but short-term differences are still possible. Tax treatment also matters, especially when comparing taxable accounts with retirement accounts. The same product can create different after-tax results for different investors. Custody should be included in the analysis as well. A fund may appear inexpensive while depending heavily on one custodian or one operational structure. A lower fee does not automatically compensate for a risk the investor does not understand. Trading frequency changes the calculation. For a long-term investor making one purchase, the annual sponsor fee may dominate. For someone trading frequently, spreads and premiums may become more important. This is why the cheapest fund on paper may not be the cheapest product to own or trade. The complete comparison should include annual fees, liquidity, tracking, structure, custody, and taxes. Ethereum introduces one additional economic feature that can materially change this calculation. Unlike Bitcoin, ETH can be staked to generate protocol rewards, and in 2026, some exchange-traded products are beginning to pass part of that economic benefit to investors. Bitcoin does not have native staking. A spot Bitcoin product provides price exposure, but the Bitcoin held by the trust does not produce a protocol reward simply for being held. Ethereum is different. Under proof of stake, validators lock ETH to help verify transactions and secure the network. In exchange, they may earn staking rewards. A staked Ethereum exchange-traded product can place part of its ETH into that validation process and potentially distribute rewards to shareholders. One representative product reported a 30-day staking reward rate of approximately 1.64% in July 2026, with monthly distributions. That number is not a fixed yield. Staking rewards can change with network activity, the total amount of ETH being staked, validator performance, and the fund's operating structure. The fund may also not stake every ETH it holds. Some assets may remain liquid to support redemptions and operations. Staking adds potential return, but it also adds risk. Validator mistakes can create penalties. Serious violations can result in slashing, where part of the staked ETH is lost. Assets may also face withdrawal delays. The trust depends on third-party staking providers, technical infrastructure, and regulatory rules. Distributions may create tax consequences that differ from simply holding a non-staking product. This is why staking rewards should not be treated as free money. They compensate investors for accepting additional operational and protocol risks. The feature can make Ethereum products more economically attractive, especially over long periods, but it also makes the comparison with Bitcoin less direct. Bitcoin offers simpler price exposure. Ethereum may offer price exposure plus variable network rewards. Despite that difference, both assets remain highly volatile and often respond to the same broad crypto market conditions. Owning both, therefore, does not provide as much diversification as two different tickers might suggest. Bitcoin and Ethereum have different investment theses, but they share many of the same risk drivers. Both can decline sharply when crypto liquidity disappears. Both are affected by regulation, custody events, leverage in the market, and changes in investor risk appetite. When investors move away from speculative assets, Bitcoin and Ethereum may fall at the same time. That means owning both does not create the same diversification as combining stocks, bonds, and cash. Bitcoin has protocol and network risk related to mining, security, and future adoption. Ethereum adds smart contract risk, protocol upgrade risk, competition from other networks, and staking-related risk. But during a broad crypto sell-off, those differences may matter less than the shared exposure to the asset class. Volatility is another important consideration. Large drawdowns are not unusual in cryptocurrency markets. An investor may believe in the long-term thesis and still panic when the position loses half of its value. That makes position size more important than choosing the theoretically superior asset. A small allocation that survives volatility can be more useful than a large allocation that is sold during the first crash. Correlation can also change. Bitcoin and Ethereum may separate temporarily when one receives a major regulatory, technological, or adoption catalyst. Over longer periods, however, both still tend to participate in broader crypto cycles. The correct way to diversify is to combine different economic drivers. Stocks depend on corporate earnings. Bonds depend on interest rates and credit. Cash provides liquidity. Bitcoin and Ethereum depend mainly on adoption, market demand, and blockchain economics. They can complement a portfolio. They should not be mistaken for a complete portfolio. To decide which one deserves the larger share of the crypto allocation, we need to compare how each asset is expected to create value over time. Bitcoin's value accrual model is relatively simple. The maximum supply is fixed. New issuance declines over time. The network is secured by miners. The price depends on demand for Bitcoin as a monetary asset. If more investors, institutions, and financial systems choose to hold Bitcoin while supply remains limited, the value may rise. If adoption slows or confidence weakens, there is no cash flow supporting the price. Ethereum's model is more complex. Users need ETH to pay for block space. Validators stake ETH to secure the network. Part of the transaction fee is burned. More applications and more transaction activity may increase demand for ETH. Staking may also reduce the amount available for trading. But more network activity does not automatically guarantee stronger value accrual. Some transactions may move to Layer 2 systems where fees are lower. Competing networks may attract users. Protocol changes may alter issuance, fees, or staking economics. The relationship between application growth and ETH value therefore requires continuous analysis. This is a central difference. Bitcoin needs monetary adoption. Ethereum needs sustainable network use that creates economic demand for its native asset. Bitcoin has the simpler thesis. Ethereum has more potential sources of utility and reward, but Ethereum also has more dependencies. Neither asset generates traditional corporate earnings. Investors cannot value them using a standard PE ratio or discounted corporate cash flow model. The analysis instead depends on adoption, supply, network security, regulation, and behavior. That is why conviction should be based on more than a recent price chart, and that principle is also the larger purpose of this channel. Before moving into the bull and bear cases, this is the right point to reinforce the framework behind the comparison. If you prefer cryptocurrency analysis without million-dollar price targets, guaranteed adoption stories, or claims that every cycle is different, subscribe to Boring Money Wins. The purpose of this comparison is not to create a dramatic winner. It is to understand what each asset must accomplish to justify a place in a portfolio. Bitcoin must continue attracting demand as a scarce monetary asset. Ethereum must continue attracting applications, users, and economic activity while maintaining value accrual for ETH holders. The ETFs must also provide acceptable fees, liquidity, custody, and tracking. If this framework is helping you separate the investment thesis from the market hype, click the like button. That helps YouTube recommend the video to more investors who want crypto exposure without treating speculation as financial planning. Conviction needs more than a price chart. It needs a clear explanation of what creates demand, what could reduce that demand, and how much loss the investor can realistically tolerate. A strong thesis can still produce a poor investment when the position is too large. A weaker thesis can still produce short-term gains when market enthusiasm is high. The goal is not to predict every move. It is to make the allocation deliberate. With that framework established, we can now examine the strongest argument for and against each product. We will begin with Bitcoin, where the simplicity of its thesis is both its greatest strength and one of its largest vulnerabilities. The Bitcoin ETF bull case begins with accessibility. Traditional investors can now gain exposure through familiar brokerage and retirement accounts. Financial advisors can allocate without building separate crypto infrastructure. Institutions can use products with deeper liquidity, regulated reporting, and professional custody. That can bring larger pools of capital into the market. Scarcity strengthens this thesis. Bitcoin's maximum supply is fixed, while new issuance declines over time. If demand expands across retail investors, institutions, corporations, and governments, limited supply may amplify the effect. Bitcoin also benefits from a relatively simple narrative. It is not trying to become every type of financial application. It is trying to remain secure, scarce, and transferable. The bear case begins with the absence of cash flow. Bitcoin's valuation depends on continued demand. If future investors become less willing to hold it, the fixed supply does not create a guaranteed price floor. Volatility also remains extreme. Large declines can occur even when the long-term network continues functioning normally. Regulation may affect access, taxation, or institutional participation. Custody concentration is another risk. A significant amount of ETF-owned Bitcoin may be held by a small number of large custodians. A serious operational or security failure could damage confidence across multiple products. Mining economics and network security also deserve attention over the long term. Bitcoin offers the simpler thesis, the larger ETF market, and stronger current liquidity. But it does not offer a low-risk thesis. The central question is whether future adoption justifies the price investors are paying today. Ethereum offers a broader set of possible demand drivers, but that broader opportunity also introduces more execution risk. The Ethereum ETF bull case begins with utility. Ethereum supports smart contracts, stablecoins, decentralized financial applications, and tokenized assets. If more financial activity moves onto public blockchains, Ethereum may benefit as a major settlement network. ETH is required for transaction fees and network security. Staking can create rewards. Fee burning can remove some ETH from circulation. Together, these mechanisms create several potential sources of demand. Tokenization may be especially important. Traditional securities, funds, loans, and real-world assets can potentially be issued and settled on blockchain infrastructure. If Ethereum remains a leading platform for that activity, ETH may gain greater economic importance. The bear case is complexity. Ethereum must continue upgrading without damaging the network. It must compete with alternative blockchains that may offer lower fees or faster transactions. It must also prove that growth on Layer 2 networks creates enough value for ETH itself. A growing ecosystem does not automatically mean every unit of activity increases the value of the native token. Token economics can change. Issuance, fee burning, and staking participation may produce different supply outcomes over time. Staking adds operational risk, slashing risk, and regulatory uncertainty. Ethereum also depends more heavily on developers, applications, and changing technology. This creates more upside if the network becomes foundational financial infrastructure. It also creates more ways for the investment thesis to fail. Ethereum offers greater utility and potential protocol rewards. Bitcoin offers greater simplicity and a larger established ETF market. The choice therefore depends not only on which asset appears more exciting, but on which risks the investor understands well enough to hold through volatility. That leads to the practical allocation question. Should Bitcoin serve as the core, Ethereum as the satellite, or should the split be different? The first allocation decision should not be how to divide Bitcoin and Ethereum. It should be how much of the total portfolio belongs in crypto at all. That decision depends on time horizon, financial stability, drawdown tolerance, and the investor's broader mix of stocks, bonds, and cash. Only after establishing the total crypto allocation should the investor choose the internal split. A Bitcoin core model might place 80% of the crypto allocation in a Bitcoin ETF and 20% in an Ethereum ETF. This may fit someone with stronger conviction in the scarcity and monetary adoption thesis. A more balanced model might use 60% Bitcoin and 40% Ethereum. This recognizes Bitcoin's larger market structure while giving Ethereum enough weight to benefit from network growth and staking economics. An Ethereum tilted model might use 40% Bitcoin and 60% Ethereum. That requires greater conviction in smart contracts, tokenization, and the long-term importance of ETH. These are illustrative splits, not universal recommendations. The correct allocation is the one the investor can explain and continue holding through severe volatility. Rebalancing should be planned in advance. If Ethereum outperforms dramatically, the investor may reduce it back toward the target. If Bitcoin gains relative to Ethereum, the opposite may occur. This creates discipline and prevents recent performance from deciding the portfolio. The larger position should not automatically go to whichever asset rose most recently. It should go to the thesis with the highest conviction, the clearest role, and the most acceptable risks. Position size can also compensate for uncertainty. An investor may hold a smaller Ethereum allocation because the thesis has more moving parts. Another investor may prefer a smaller Bitcoin allocation because an asset without cash flow is difficult to value. The final decision matrix brings these differences together and shows when each ETF may deserve the larger share. Bitcoin has the advantage in simplicity. Its thesis depends primarily on scarcity, security, and adoption as a monetary asset. Bitcoin also has a larger exchange-traded market, deeper current liquidity, and the more established institutional narrative. Ethereum has the advantage in network utility. It supports applications, stablecoins, tokenized assets, and programmable financial activity. Certain Ethereum products can also earn staking rewards, creating a potential return source that Bitcoin does not offer. But Ethereum has greater protocol complexity. Its success depends on developers, applications, competitors, Layer 2 networks, staking economics, and future upgrades. That creates higher execution upside and higher execution risk. A larger Bitcoin allocation may make sense for someone who prefers the scarcity thesis, wants the more mature ETF market, and accepts that valuation depends heavily on future demand. A larger Ethereum allocation may fit someone who believes smart contract networks will become important financial infrastructure and who understands the additional technical and competitive risks. For many investors, the most defensible default framework is Bitcoin as the core and Ethereum as a higher-risk satellite. That is a framework, not a universal rule. Someone with low conviction in both should not force an allocation. Someone unable to tolerate a severe drawdown should keep the total crypto position small or avoid it entirely. The final decision should follow 4 steps. Choose a thesis, control the total crypto allocation, set the Bitcoin and Ethereum split, then rebalance instead of chasing performance. Bitcoin offers the simpler story. Ethereum offers the broader economic experiment. Neither deserves a large portfolio position merely because its price is rising. Understand what creates the value. Understand what could destroy the thesis. Control the risk and let boring money win.